Hello everyone, very good evening to all of you. Welcome you all in the session of Oliveboard. Myself, Saloni Gupta. Please confirm me my audibility and visibility. Myself, Saloni. Everything is fine. I hope I'm audible, I'm visible, my PPT slide, audibility, everything is fine. So yes, in yesterday's class, we completed unit number 9. We did what is capital budgeting. Then we have done various methods like ARR, average rate of return, then NPV, then profitability index, okay, IRR. So we have done all these methods and we have done one practical questions of each method, ARR, NPV, and profitability index. That so these were the most important concept that every time they do repeat, every time questions definitely come from all these sections, from all these topics. So we are here to cover only the important concepts. Now, in today's session, see unit number 9, unit number 10, and unit number 11. All these units are interrelated to each other. That is, all these units are of capital budgeting. Just the difference is of in unit 9 what we have studied that how we will going to decide when we are opting any kind of investment, when we are selecting any kind of project for investment. So what are the decision criteria that we have to keep in mind, how we will going to select that project on the basis of some decisions. In unit 10, what we will going to study over here, that if we want to invest in any foreign in countries project, like in unit 9 we have invested in Indian project, but if we want to invest in any foreign project, then what are the decision criteria, okay, how we will going to invest, because the currency is different. In our uh, in India the currency is in rupees, and in foreign country the currency may be according to that country, maybe in euro, maybe in dollar, maybe in yen, okay, maybe in British pound sterling. So whatever the country is according to that country's currency, we have to invest, we have to do the investment. So in this particular unit, we are targeting what capital budgeting for international project investment decisions. How we will going to take the investment decisions when we are investing in internationally, when we are investing in international projects. So what we have studied in unit 9, everything is same. Done. Every method will be same. Everything, every calculation will be same. Just the difference is of one thing, and the difference is of the currency value, the value of currency, the exchange rate of currency, the spot rate. Okay, so these things will only differ from unit 9, else everything will be same. Now, so let's move to the unit. So, what are the ways, methods, discounting techniques? Everything will be same except the one thing, that will be the currency. If the project is given, if you are investing in international projects, so currency of that country will be dollar, euro. So what you have to do, you have to do the you have to multiply after getting the proper decision, okay, criteria. After analyzing all the projects, what you have to do, you have to multiply that amount with the exchange rate of your country, then you can get the value, the proper value of your country. So first you have to, if you want to invest in any foreign country's project, then you have to exchange your rate, exchange the rate of your country, okay, according to that project, or and vice versa. So cash flows are either they will be converted in home country's currency, or they would be converted in foreign country's currency. So what are the considerations that we have to keep in mind? Foreign and home currency cash flows. So cash flows, either they will be given in foreign currency or they will be given in home currency. So what you have to do, you have to change accordingly that all the cash flows. When dealing with foreign and home currency cash flows, there are several considerations that we have to keep in mind. The first is exchange rate fluctuation. Yes, definitely. In our country, there are every day, every week, every month, there are fluctuations happening. So definitely the exchange rate will also fluctuate in our country as well as in their country. So exchange rate fluctuation, this is the first point that we have to keep in mind. And with this exchange rate fluctuation, what happens? Your cash flow will also change. There will be a impact on your cash flows. So they do change. Cash flows in foreign currencies are subject to exchange rate risk. As the exchange rate increases, decreases, according to that, the cash flows increases or decreases. So, which can affect the value of cash flows when converted to home country, home currency. Now, inflation differences again. Inflation, if there is high inflation, then definitely the exchange rate, the currency rate according to that country will be high. Okay, so inflation differences, this is the second phenomena that we have to keep in mind. We have to do the analysis of this while investing in any foreign country. So they will also impact what? Our cash flows. Inflation rates can differ between countries, impacting real cash flows. When investing, when you are investing, then you have to keep in mind all the evaluations, all the analysis. According to that, risk will also come. You have to adjust the risk. So it is not very easy to invest in any foreign country's project. You have to study the whole market. You have to study the whole risk phenomena. If any risk is coming, what are the techniques you will do for minimizing those risks? So definitely there will be a lot of things coming into your way when you are investing in any foreign country. And foreign currency discount rate computation, that is what? Converting local currency into foreign currency is done at a prevailing rate, which is called spot rate. So what is spot rate? Suppose today is what? Today is 14th Jan 2025. So on this particular day, you are investing in any foreign country's project. Now, on this day, what is the current market price prevailing in that country? On this date, what is the current market price prevailing in that country? For example, let's take an example for today. Okay, as of 14th Jan 2025, $1 equals to 85 rupees. So you are investing today. So what $1 will cost? Rupees 85 rupees. Now, suppose if you are investing after 2 months, like you are investing on 14th March. Now, what is the current prevailing rate in that country? Let's take an example. $1 it becomes 87 rupees. So this is what? This is the spot rate that is done at the prevailing rate, which is called spot rate. So this is the rate which is prevailing in the country, in the foreign country. That rate is known as spot rate. Am I clear with this important topic? Now next. Okay. So yes. Now, direct and indirect channels for international investment. Okay. So it basically tells ways to invest in international market. Okay. So directly invest in domestic country. If you are domestically, we have different channels, different ways for investing. We have direct equity, we have equity, just mutual funds, debt mutual funds, NPS, PPF, bank, SCSs. So these are all of domestic, that is of our country. Internationally, what we have American depository receipts, that is known as ADRs and GDRs. Global depository receipts, foreign direct investing, global mutual. So all these are related to what? These are related to internationally. So there are different ways to invest in international market. Directly, we have these type of elements, and internationally we have such kinds of elements. Now, what is ADR and what is GDR? See, every country has their own depository receipts. Suppose I have purchased goods from your country. Now, so how you will going to know that I will give you the money or not? You don't have faith in me because we don't know each other. But due to globalization, we are building what? Trade and commerce. So how would a buyer How would a seller know that I will pay the money to him or not? So for this scenario, what we have depository receipts in every country. So there are ADRs and GDRs. GDR is what? When an when an Indian company raises funds from international market, then by selling their, you can say by selling their equity, by selling shares, then it is known as global depository receipt. Clear? Now, when an Indian company raises funds from America, when an Indian company raises funds from America, then it is called what? American depository receipts. And they can raise funds with the help of equity, shares. Okay. So this is what ADR and GTR. No. Multinational corporations, in case of indirect channel, the investment is made into certain intermediary mutual funds who in turn invest into various sectors. So what we have different indirect channels as well. These are what? These all are the direct channels. Now, what is an indirect channel? Suppose, let's take an example. This is an Indian investor. Okay, here is an one Indian investor. Now, this Indian investor in investing in the mutual funds, and this mutual fund is Indian mutual funds. Now, this particular mutual fund, what this mutual fund will do, this fund will invest in any other mutual fund which is situated in any foreign country, which is situated in any foreign company. So this is what? My money which I'm investing in this mutual fund, this money is being transmitted to this particular mutual fund which is situated where? In any foreign country. So this is what? This is an indirect channel example. I have invested in Indian mutual funds. Now this Indian mutual funds are investing in different countries mutual funds. So this is an indirect channel. Here, tell me, any doubt to anyone? Okay, sure. So this we have done. Now, what are the returns and risks if you are investing in any, if you are making an investment in any foreign country? So definitely, if there are high returns, if the risk is high, then definitely the returns will also be high. Or if you are expecting high returns, then you have to bear high risk, because if risk and return, so both go in a same direction. Now, what are the potential returns? Returns means the profits of foreign investment. So what are the profits of foreign investment? First is diversification. Yes, if you're investing in different projects of foreign country, so the risk will what? The risk will diversify. Suppose from this project you're not getting a good return. From this project you are not getting a good return. But from this project you will definitely get a good return. So it is not possible that wherever you are applying, wherever you are investing, every project will give you a negative returns. No. There might be some projects which will give you negative return, but most of the project they will give you positive return, because you have analyzed those projects, you have studied properly, then only you have invested now. So the diversification of risk, risk is diversified. That is risk. There are chances of less risky projects. Growth opportunities, yes, definitely. If we are investing in any foreign country, so returns will be high, because the rate, according to the rate of that country, we are getting the return. So our country's money is less than the foreign country's currency. So growth, there will be growth opportunity. Then currency appreciation, yes, again, if there is a proper growth, we know that we are doing a good business. Everybody is knowing us. We have a business in India, and our business, most of the people will know in foreign country our business, because we have invested in their company. So with this, what happens? The If the opportunity of growth increases, then definitely the currency value also increases. That is appreciated. Appreciated means it increases. Access to different industries, yes, we can have the access to different industries, working with them, okay, investing in their projects. We will see how they are uh, running their business, what are their agenda, so everything we can know. And higher yield means the high profit. So these are the good returns from making an investment in foreign country. Definitely, if there are returns, then you have to bear risk as well. So what are the risk of foreign investment? The first is currency risk because the fluctuation, the market condition you need to study. Then political and economic risk. Yes, there may be political intervention more might be in some countries. Economic risk will be there. The fluctuations of the currency rate, inflation, deflation. Market risk. The market risk according you have to study the whole market properly. You have to do the proper analysis. So for these things, you need time also. You need money also. You have to give more effort also. Cultural and operational risk. Yes, you have different culture in your India. In some other country, they have might be having different culture. Operational risk is what? The failure of system. The failure of system. Operational risk will include such kind of things like system has been failed. Okay, not the proper discounting is not done. So these are the things which are included in operational risk. So risk will come if there are high risk, then there are chances that returns will also be high. Done? Clear? Now, there is one important model in this particular unit. We called it CAPM model, the capital asset pricing model. So, capital asset pricing model is what? It basically tells the relation between the return and what kind of return? The expected return. The return which you are expecting from any particular project. And with the return, what else you are getting, you have to bear the risk also. So it basically describes the relation between the expected return from the project and the risk which is related to this particular return. The risk related to this particular return. Yeah, this is what the CAPM model says, capital asset pricing model. Now, it is the foundational concept in finance that establishes what a relationship between the expected return and the risk. The returns are always based on the risk and the time value of money. So yes, definitely we have seen what is time value of money. We have read this in our previous chapter. The time value of money, what is discounting. So on the basis of such factors, what happens? The risk arises. If the risks are more according to that, to time value of money, we will be getting our returns. It is generally done for risky assets so that the price is appropriated to generate expected return. So those projects which are of very risky nature, it is basically done on that. So to know what can be the return, what can be the expected return we can get. Suppose we have invested 1 lakh rupees and in return I'm expecting that at least 1.2 lakh rupees I'm getting back. But the risk is very much related to this particular project. So it might happen that you may get 1.1, might happen that you may get 1.05 lakh. So according to the risk, your return determines according to the risk of the project. Yeah. So its formula is RE is equal to RF. RF is what? Risk-free rate. Okay. Beta is what? Beta is levered risk. The levered risk is beta. Okay, let me write this page. See, what is the formula of CAPM model? It is RF plus beta RM minus RF. This is the formula. Now, RF is what? RF is risk-free rate. Beta is the levered beta, means the risk. RM is what? Expected return. Expected return on the market. Expected return which you are expecting from the project. RF is again same the risk-free rate. Here and RE is what? It is cost of equity. No. Based on these, okay, formula is what formula is given to you. This one. I'm giving you one question. Please solve and tell me what is the answer of this particular question. I hope you have calculator with you. No. Suppose in the question RM is given 16%. Very easy question I'm giving you. RF is given 8%. Beta is 1.4. Now you have to find what RE. RE is what? So RE is equal to, this is the formula. Put all the values on this formula and tell me what should be the answer. The formula is what? RE is equal to RF plus beta RM minus RM. RF is how much? RF is 8% plus beta is 1.45. Now RM minus RF. So 16% minus 8% is how much? Again 8%. So it is 8%. So with the BODMAS rule, what you have to do? First, you have to multiply this 1.45 into 8%. How much it will come? 11.6%. That is 19.6% is the answer. I hope this is clear to you. So this is what our cost of equity from the CAPM model. Now, next is arbitrage price theory. The arbitrage pricing theory, this is one level up of CAPM model. In CAPM model, what we see the relation between the expected market return and the risk associated with it. Now, arbitrage pricing theory, what it tells that basically the arbitragers, how they get the advantage of any project from the, you can say, from the mispriced securities. Okay, let's have a very, very basic example. Like suppose I have purchased goods for rupees 100. Okay, I have purchased goods for rupees 100 from ABC ABC Limited. Here now, I have purchased goods of rupees 100 from ABC Limited. Let's take an example of you can say, okay, mobile cover 1000. Now I have purchased this. Now I am selling the same mobile cover to another shop, PQR Limited, for rupees. Simultaneously, I know that the price of mobile cover in this particular shop is, every mobile cover worth rupees 1200. So I will purchase from any particular shop, that is ABC, and I am going to sell this mobile cover to this new shop, that is PQR Limited. So how much I'm getting a profit? I'm getting a profit of rupees 200. I know that here the price is less, and in this shop the price of mobile cover is very high. So I will purchase the price at low prices from this shop, and I will sell to this particular shop at high prices. So the difference between two prices is what my profit is. So this is called the arbitrage. Arbitrage means simultaneously, if you are doing purchasing and selling simultaneously, that is what? That is arbitrage. It is a multi-factor model that provides an alternative to CAPM model. CAPM, it includes returns, market returns, and risk. Whereas this method of theory goes beyond it, means one level up, thinking that markets sometimes misprice the securities. So when we know that, suppose in this case, for a certain day the price gets 1200. Rest of the time the price is, you can say, a very cheap. But certain day the price gets very high, like for like on the eve of New Year, on the eve of, you can say, Christmas. Okay, on the eve of festivals, what happens? They increase their prices. All shops will decrease their price, but they increase their price for some reason, for might be some of the reason. So what happens? The mispriced securities, from this they will earn their money. That is called arbitrage. And who does this kind of job? Arbitrages. And So they have their core product. That is why they are increasing their prices. So this basically happens in case of shares when the market fluctuation happens in securities because the security shares prices goes up and down. I am giving you this just a basic example. So let's do this question. This is the question of what from arbitrage pricing theory. What you have to do, for example, the following four factors have been identified as explaining a stock's return and sensitivity to each factor and the risk premium. So, in every statement, you will be getting one risk premium. Risk premium is what? I know that this particular uh, thing is very risky, like GDP. It is very risky in your country. So, to cover risk, what country gives? The country gives the risk premium. It gives the premium to cover the risk of that particular element, particular component. So risk premium is associated with each factor and have been calculated means risk premiums. RP stands for what? Risk premium. Now GDP of the country is given. How much GDP is given? The beta. Beta is what? It is risk. We have studied beta is what? Risk. So it is given 0.6. Now to cover this risk, the risk premium of 4% is given. Again, inflation rate is very high in your country. So it is the risk is what 0.8 and to cover this risk premium is 2%. Now gold prices again the beta that is the risk in your country is 0.7 and it is minus. If you will see this thing, it is in minus. Risk premium to cover this risk because it is in a negative to cover the risk 5% is given. Now Sensex index the beta is 1.3. It is very high. Risk is very high 1.3. To cover this risk 9% of the risk premium is given. Now without risk-free interest rate is given that how much I can earn from your from your country without facing any kind of risk, just 3%. So it is given. Now, using APT formula, arbitrage pricing theory formula, what we have to find? We have to find the expected return and how we can calculate this. See, what value is given without a risk premium? Risk-free rate is given 3%. Simply write it 3%. Add all the sum. Why? Because we have to find the expected returns from all of the elements. Now, GDP is what? GDP is given 0.6 and to cover the risk, how much risk premium is given 4%. Simply multiply this. Then do addition. Second is what given? 0.8 given inflation rate and to cover this beta, this risk, how much percent risk premium is given? 2%. Simply multiply with 2. Then add gold prices. That is, it is a negative. Minus 0.7 into 5%. Again plus 1.3 into 9%. If you will calculate this, you will get value 15.2%. So this is the all the factors. Okay, every if you will calculate, if you will sum up all the factors, so what the arbitrage, what exactly the answer comes, that is 15.2%. So using arbitrage price theory, arbitrageurs can take advantage of any deviation from fair market value. So this is the fair market value and the risk premium is given to cover the risk. So this is the premium given to cover this risk and from this how much percent can earn, that is 15.2%. Here, okay. Now, next, what are the approaches for evaluation of overseas project? The home country approach says what? All of the cash flows of the project first they have to be converted into the home country. This is included under home country approach. And if we are opting for foreign country approach, so all the cash flows of the project they will be converted into the foreign country currency approach. So there are two types of approach and every method will same the same NPV will be there, the same IRR will be there, payback period, average rate of return, okay, MIRR, all methods will be same, all ways will be same to calculate the Proper risk, proper return of the invested projects in international country. Done. This was important. Till now, this question has not been came in the exam. So there are high chances that might they will ask this type of question. If they want to make the level of the question high, so they can ask such type of question. Okay, I hope it is being clear to you. So in such way, you can calculate all of the, you can say all of the factors, all of the components of the stock return. Okay, so now let's meet tomorrow with another unit, that is unit number 11. And if you think that all these sessions are helpful to you, then kindly like the sessions and share it with others as well. So let's meet tomorrow at the same time. Till then, take care, everyone. Good night and keep studying, keep watching.